Sustainable mortgage-backed securities and securitized products enable you to support market access to communities and projects that have not had access to credit historically. How large is this market and what role can it play in your portfolio? A conversation well worth your 10 minutes right here on UBS Trending. Hi everyone, and welcome to UBS Trending. I'm your guest host, Amantia Muhedini. Leslie and John are my guests here today, and we're here to discuss sustainable mortgage-backed securities and securitized products. So let's get right down to it. Before we dive into the sustainability considerations, Leslie, please remind us of the current view and outlook on the asset class, please.
Yeah, absolutely. I mean, when you think of mortgages and securitized products, it's really sort of a vast and multiple type of assets that you have within there. It really depends on your cash flow needs, your risk tolerance. But really what we're going to focus on today in particular is the agency MBS market. And the agency MBS market is, is a AAA sector that throughout the past, I would say 2 years has, had a few bumps in the road, mostly due to technical, not fundamental reasons. And when we think about what had happened in 2022 and this very large rise in U.S. interest rates, the higher quality fixed income underperformed, which included agency MBS. So coming into this year with the expectation that volatility would drop, we had expected agency MBS to do actually a bit better. Obviously, we went through a bit of financial instability in March, and so we had supply come into the marketplace. We had some technical headwinds, not fundamental, because the housing market's recovered. This is a AAA asset. So what has happened when we think about this sector as a AAA, over the past 20 years, you're earning a spread that you haven't earned since like pre-Great Financial Crisis. You're earning a yield that you haven't earned. So the sector in and of itself is really incredibly cheap. And as a matter of fact, when you look at spreads that are for, say, what we call a basic mortgage-backed security at, say, 170 right now, it's for a AAA. A BBB corporate is about 160. So that's really the kind of relative value that you're able to earn in the sector right now.
Right, that makes sense. And I mean, look, in addition to the fundamental view that we have, and you talked through the kind of the technicals that have been challenging, we're interested in this sector also from a sustainability perspective. This is the work that the three of us have been doing over the last maybe a year now to come up with a view on sustainable agency MBS and broadly securitized as well. So John, welcoming you in the conversation now. Tell us how we're defining sustainable securitized and agency MBS.
Sure. So most investors are going to be familiar with what securitized products are. So let's focus a little more on the sustainability aspect. And to identify a sustainable securitized product, we generally recommend two things. First, you want to look at the underlying pool of assets. Are they, you're looking at the borrower of the assets, you're determining if they meet certain social or environmental criteria, whether it's a social bond or a green bond. These criteria may be a number of things. Are they going to low to middle income families? Are the borrowers meeting that less than 80% of area median income? Is it in a FEMA covered region, a minority census tract? Or is the building itself meeting certain LEED or Energy Star certifications? Second, you want to look at the structure and the originator. So for the structure, you're looking at the servicing standards. Are there credit protections for the borrower, or could there be adverse incentives for the originator? When you're looking at the originator, that might require a little bit more of a deeper scrutiny, a little bit more research on your part. Generally speaking, issuance from government-sponsored entities are going to meet those sustainability criterias. But as you look at the non-agencies and the private label issuance, investors are going to need to do a little bit more research, and that's where we think our framework and is going to be helpful as a guide.
No, that's right. I mean, look, and we have these conversations when it comes to sustainable investing in general, right? We believe that it applies to every asset class. Here we are defining it for within this asset class, but investors still need to do their diligence to understand what's truly authentically focusing on these sustainability benefits. So a lot of what you're talking about, looking at what's the collateral, who are the underlying borrowers that are being collateralized in these pools will be important. And the originator point as well is also important. We just had a chart that looked at the growth of labeled products in this space. So tell us a little bit more about who the issuers are, and maybe give us an example of kind of what's one example of a security that an investor may find.
Sure. So as you pointed pointed out, the growth has kind of been trending upwards now for a few years. Right now, we generally see that the largest issuers are going to be the government-sponsored entities, Freddie Mae, Ginnie Mae, and Freddie Mac. But now that said, you are seeing some more growth from non-agency and private label issuers. If I can go back a minute, those agencies, they're accounting for about 35% or more of issuance in recent years. And within that subset, Fannie Mae itself accounts for about 50% overall. The issuance was growing before the pandemic, especially among, as I mentioned, those non-agency and private label issuers. So this is an area that we think they're starting to catch back up to where they were pre-pandemic now in this post-pandemic world. So somewhere, this is an area where to watch for and to see that continued growth, even as the GSEs continue. So if an investor is looking at a single security, what you may find in that portfolio is, you mentioned, the labeled bonds. So these are going to be typically third-party certified to make sure they're meeting certain sustainability criteria so that an investor can feel confident that it is going to those sustainability goals. So actually one I was looking at recently was a labeled social bond, and it was backing affordable housing in Washington, D.C. And if you actually went, I was able to find the website for the apartment complex, and it said specifically that in order to qualify to be an applicant to live there, you had to be between 60% and 80% of the area median income. So you kind of see those common terms coming up again. Now this just gives you a sense first of what is out there, but also some of that little extra digging that you're going to have to do. Again, I was able to look up the actual apartment complex itself. And this is, might be something investors have to do to make sure that they are investing aligned with their goals.
Right. No, that makes sense. And it's a very good example with affordable housing, because often when it comes to communities that are low income, in specific census tracts, have female or kind of racial minority heads of households, those have been historically not part of getting access to credit. And so this is what enables investors to kind of get that exposure. On the other hand, and maybe Leslie, you can talk a little bit about this, these credits are still, or these products really are still AAA bonds. I mean, they still have the same characteristics from a financial return perspectives. So with your experience in watching the agency MBS market for a long time now, have you seen it grow? What's your fundamental perspective on sustainable as an angle here?
It's definitely grown. I mean, the agency MBS market in of itself is one of the most liquid sectors. And within that, we've seen sustainable agency MBS grow a tremendous amount over the past several years. And obviously investors become more comfortable the more data that they have. I mean, John just really brought up an example about being able to look on a website. I mean, all these kinds of things to have access to information in a growing sector is really important. So I do think that, as time goes on and as there's a lot of scalability here within agency MBS or even through something such as securitized, whether it's solar or green building, all these kinds of things that I think are really going to start to become scalable as the more data becomes available. It's going to be a very good, not just a very good sustainable play, but also a very good relative value play. And I think that's where we see this right now in terms as well is, historically the returns on sustainable agency MBS are actually very similar to that of agency MBS.
That's right.
And now that we are what we consider a most preferred, really even in our fixed income portfolios, it really works well to have the ability to do sustainability with an asset class that we believe in from a sustainability standpoint, but also from a very good relative value standpoint.
No, absolutely. And I mean, this growth really points to the innovation that we're seeing in the fixed income market and in sustainable investing. It keeps growing. So more to come. I'm sure we'll be back here for another conversation, maybe a check-in on how the asset class is doing on performance. So thank you very much for joining me, and thank you for joining us for this conversation. For more information, visit ubs.com/views. And UBS Trending is on social media. Follow us on Instagram at UBS Trending for content that you won't find anywhere else. You can also check out LinkedIn, Facebook, and Twitter for more. And as always, if you have any questions about your portfolio, please speak with a financial advisor. Until next time, I'm Amantia, filling in for Anthony. Have a great rest of the day, and remember to keep your eyes on what's trending.